was saying about how it took 100 years for the steam engine to show up in productivity, I think we just had a shock that just sped up a transformation that normally would have taken 20 years. We did it in one.
It's really an unbelievable thing to have lived through.
I also don't think anybody has the answers for how this plays out, what this looks like in the future. Like, how could anybody possibly know what happens 24 months from now?
I don't even know what's going to happen in November.
Here's Peter Bookvar. We love Peter. While somewhat dated, at least in June, the U.S. economy had a record number of job openings, 10.07 million. That was 800,000 more than expected. Great job with the expectations, guys. And up from a revised 9.5 million in May. Positively, too, the number of hirings rose by 697,000 after a little change in the prior 2 months. The number of quitters rose. Quit rate 2.7%, second highest since the survey started in December 2000.
So that's the thing. It's like people are quitting.
We have this chart, John.
Like they've never done before.
This is like not what you would expect to see a year after a recession. A quit rate with that level of confidence, like people just being like,
I'm out.
I don't need this anymore. But
Allison, we were talking about the extended unemployment benefits, but even states that suspended that are not seeing like people flooding back to work.
Well,
yeah.
So,
go ahead.
Oh, sorry. No.
No, you go.
Okay.
No, you go. It's a podcast. Both of you go.
So there's, another thing that, I think we're not talking about yet is this whole matter of excess savings, right? Like this whole, like the additional, like the rate at which people were saving their income, over like whatever the pre-pandemic level was. And then you start that from March and go into now, and there's like $2 trillion in excess savings that consumers have accumulated.
That's got to be helping fuel the quit rate, because you're not quitting your job if you don't feel confident that you can live for 6 months without income while you figure out what you want to do next.
So Nick Bunker at Indeed does a survey that revealed something like this. And one of the big reasons why people aren't urgently seeking a job is because they all have these financial cushions, whether it's stimulus checks or whatever, or not having spent anything while they were working from home.
You know what bullshit survey we don't hear about anymore? 40% of Americans don't have $400 in emergency savings.
Yeah, we fixed that.
Everybody has that right now.
We fixed that. Let me put it to you this way. Was the second round of unemployment benefits from the federal government bad policy? Was that a mistake? Was it poorly targeted? Was it poorly thought out? What do you think?
Well, I mean, I wouldn't say it was. I mean, if
did it stop people who would otherwise have gone out and filled some of these 10 million jobs from doing so?
Probably I think these things work on the margin. Sort of like you're home, you don't have good childcare, and someone's paying you more to be at home. I think that's the tipping point. I don't think any one thing does it. I think it's this confluence of thing. And like probably, honestly, a lot of these people who are home are like, I would love to go back to get a job again. I'd like to get out of the house and stop looking after like 4 3-year-olds.
Right.
But it's like you layer in that they're going to be losing money to do that, then they don't.
Taking care of 3-year-olds is like the hardest job in the country, and there's no compensation for it. We don't pay moms to be at home or dads to be at home with children. It's a kind of a weird thing, because I wouldn't do that job if I were given that choice.
Yeah, and everyone who has small children really had a hard time this last year. That stuff.
Right. So all right. So but like if we could do it all over again, do you think we would have less open jobs, or is that too small of an answer?
So you mean extending the enhanced unemployment benefit, or the big checks we gave out? Well, the big checks were just based on your income. So, I mean, I am more pessimistic on them because I just feel like they were expensive and unnecessary. Assuming interest rates stay low forever, maybe it won't be a problem, but it's just sort of added more to the debt load.
Allison, I want to ask you about this. Huh? What do you think this does to forward policy? Like the way that, I think what I think is that this exogenous shock was so obvious that we needed to battle it, and nobody was going to say, no, we can't do that. So like Ben is saying that in the next recession, politicians are going to act quickly because their base is going to pressure them. Why not? It worked last time. But I think that unless like one party really has control of both sides, that there's not going to be the political like wherewithal to come together. Because I think that unless there's another one of these, God forbid, we can't even agree when we're in the middle of a recession if we're actually in a recession and the policy response that's appropriate. So how do you think this is going to affect future decisions?
I think it'll depend on the nature of the next shock. Who's at blame, what's the nature? I mean, one of the reasons I think the money worked so well last year is this is a supply shock. So it wasn't that, people just didn't want to spend, it's that they couldn't. So I think the prescription's a little bit clearer. When you're in a demand shock, like from a financial crisis, I think the right policies are less clear. So there's more scope for debate. I mean, we probably won't be that thoughtful and nuanced next time. We'll be like, I think everyone's going to want to be like, let's throw money at everything.
Because it worked last time.
And people like it. Politically, it's always a winner.
We had this also once in a lifetime situation where the president is a guy that like doesn't care about debt and loves the idea of throwing money at problems. Like that's his entire life. And so when Democrats in the Senate and the House urgently wanted to do something that involved blasting money out, he looked at the president at the time in a different party, looked at it like, hey, you know what? I actually like this idea too, and mobilized Treasury. And like Treasury, the Fed, and Congress all working together with the same goal, get checks out now. We'll figure out how to pay for it later. You may never see that again, even if people want it.
And it was at every level, like corporations, government debt. Like it was just everywhere. And I think that also, I mean, it'll be very different if suppose the next 4 or 5 years we have sustained inflation that really cuts into real wages.
So I wanted to ask you about this. In terms of like what you learned getting your PhD and monetary supply expanding, and yes, we are seeing inflation in areas that have been impacted. Obviously, used cars is a big one, used cars and trucks. But what do you think the inflation ramifications are going to be 6 months from now? I guess like that's up for debate, but what's your opinion?
You know, I don't think we're gonna have like hyperinflation. I don't think inflation is gonna be like 10%, but I think it's gonna be higher than what we're used to. And I think real wages could fall slightly. And
that would be problematic.
Yeah, so people are going to feel hurt, but it's not going to be as obvious as, oh my God, I don't know what things are going to cost at the grocery store tomorrow. And as I said, that could weigh on things. That also could increase interest rates, which might mean we can't afford to do these sorts of things in the future.
Nick Colas took the July CPI which came out yesterday. We're taping on Thursday night. Took July CPI, pulled out used cars and energy. 2.3% headline. 2.5% core. It's not inflation.
Yeah.
Like it's not, I mean, that's not like, so arguably it's transitory already. And then a lot of what could dictate the future path of that probably is shelter costs. Like our rent's going to keep going up, our home price is going to keep going up.
Yeah, but we also see wages going up. So wages don't go back down.
But let me ask you this.
But they don't expand at that same rate forever
If we're seeing a lot of the wage gain at the lower end, and those are people that are pumping money into the economy, right? They're spending their money. Isn't that a good thing? Like, shouldn't we want that? Obviously, nobody wants the potential inflation associated with that, but couldn't that be very good for the economy?
Could be. You know, especially, as I said, if they have more security. If, as I said, they're more financially secure, that's really good. But as I said, we just don't know. I mean, it could just sort of feed up the whole wage cycle, and if everyone's getting paid more, then you do have inflation. I think what makes inflation is changes in expectations. So if people become convinced the idea that inflation's higher, it becomes self-fulfilling.
Okay, what have you guys been doing on inflation lately?
Exactly that. It's used car prices.
I mean, that's like such a huge component of it.
Right.
Why does anyone think that condition is going to persist past the summer? It's
well,
weird
used
to me.
cars, it already stopped. Well, it stopped at least temporarily. They were up like 0.2% after being up 10.5% the month prior.
Right. So, you know, this also relates to, University of Michigan, you know, does that big gigantic sentiment survey, and one of their they have a sub-component thing where they compile consumer sentiment towards buying houses, durable goods. And I think cars are the third part of it. And basically there's this outrage over, you know, how expensive everything has gotten. But these are all things that, you know, I'm sure there are some people who are urgently trying to buy this stuff because they need it for work or whatever. But these are all things that, you know, can be delayed. It's not like,
unless your lease comes up like Josh's did.
But also you buy it once. If you buy a used car in 2021, you might rage at a survey how much you had to pay for it. You're not buying one the next month.
Right.
So it's hard to say that one high price of a car that you bought affects your expectations about everything going forward.
Right.
Maybe it does, but I think for most people it probably doesn't. So I'm in camp transitory. I've been for a while. Where are you? Do you have like a strong opinion or not really?
I think it's going to be higher than it was before. I don't think it's going to be, as I said, I don't think it's big. I don't think it's going to be more than 5%. It could get up to 3 or 4, though.
Isn't that what the Fed has been trying to do, though?
Yeah. Well, no, I think they don't mind it being like 2.5%. They're like, our target is 2, and 2.5 is good.
I just watched them spend 10 years promising inflation.
Mm-hmm.
Here it is.
Oh, as we have an economist in the house, you, Allison.
Uh-huh.
Could you just school us on like the real impact of buying all the mortgage-backed securities, how that impacts the housing market, if at all?
Well, definitely, like it makes mortgages cheaper, right? Because it's less risky to lend.
So that's it. That's long and the short of it.
Yeah, I mean, it also probably makes lenders less sensitive to risk.
So it's undeniable then that all of that activity that the Fed was it $40 billion a month buying mortgage-backed
I
securities?
think they're still doing it too.
Yeah, still
It's
doing it.
undeniable that that's having an impact on prices.
Yeah, because I mean, what's a mortgage rate right now? Like 2.9%.
Still very low.
Still so low.
Right.
It's crazy that like our parents paid like 9% a mortgage rate. Can you imagine?
Or higher.
I know.
All right. So do you view that as like a settled argument? Like, yes, there is home price inflation and it is being driven by the Fed, and why are we making it more complicated than it has to be?
Well, there could be other factors
Well,
too.
demographics.
Yeah.
I think it's as much demographics as anything.
Yeah, I think low mortgage rates are a huge part of it, but there's other aspects to it like demographics, demand.
There are what 70 million people my age like looking for houses for the first time, so that'll have an impact.
How old are you?
36.
There are 70 million of you, or around that age. Yeah, I think that's right. I think the most common age in America is
It's
like
like 35.
30 or 35. Okay. You wrote something, Allison, about universal basic wealth versus universal basic income, and I feel like you put yourself at great Twitter risk with an opinion like this. So I want you to defend it. And no, I'm just kidding. This is you. The strange new policy idea coming from Silicon Valley is universal basic wealth. It's like universal basic income, except you get a pile of money once, twice, or several times to build your bank balance. And then you're talking about how it's being proposed by like Eric Schmidt from Google and Evan Spiegel from Snap. And they want the state of California to basically give people money, which automatically gets put into startups, which I thought was funny. I didn't even read what they had to say. But I don't hate the idea as much as you do. I do like the idea of if we want a level playing field, not level, all right, we can't give everybody the same outcome. But if we could give people, get people closer in terms of like where they're starting, isn't that a more fair world than what we have now, where people born into wealth almost can never fall behind, and people not born into wealth have a very difficult time catching up, and most of them can't ever, just because of compounding and other advantages. So why are you against this?
Well, I'm not. I also would like.
Why are you such a horrible person? That's what I really want to know.
I also would like to level the playing field. I just wonder if this is the best way to do it because, like, I mean, just the details are so vague to me. It's like you're giving people a pile
What's
of.
so hard? Here, you own a startup.
Every baby should be an angel investor.
Every baby is an angel investor now, and we pick the investments for them. And Eric Schmidt sits on the committee.
No, they go on angel list, and the representatives select the most
Well,
attractive
Eric Schmidt
investment.
was very clear. It goes through VC professional investors.
Of course it does.
Yes,
How could it not?
These people who never lose money for anyone, and get
Will
these
the
extraordinary
babies
returns.
be paying 2 and 20 is the important thing.
I'm sure.
Okay, so it's almost like the plot of a movie. It's obviously ludicrous, but the general idea of baby bonds,
Exactly.
which
Allison,
I think is more straightforward.
let me quote you. You said that seems suboptimal to me. So many models of life cycle savings and public finance are exploding in my head.
Because you're really putting a constraint on people. Like what you're going to give people money on what you have to put terms in on when they can spend it. Otherwise, you're just giving them like a transfer like we did last year.
What if there was like a credit card use it or lose it type thing? Like to your point.
What do you mean? Use it or lose it?
Like you spend this money in 90 days or it vanishes.
Well, what are you trying to achieve? Just get people to buy more stuff?
Yeah,
Consume.
that's what we do.
Okay, but where does that money come from?
Our kids.
Yeah, what's the problem? Grandkids. They're angel investors. They'll be fine. Wait, so all right, so you're saying that the idea is okay, but this doesn't this doesn't sound like it's actually going to work because there's a mismatch in timing.
Well, I'd prefer to have policies that are more targeted, right? So there's no doubt about it. You have an advantage if you have parents who can pay for your education and can help you buy your first house, right? So why don't we just have policies that target those things for low-income people rather than giving people this pile of money and put all these strange restrictions on how and when they can spend it?
Wouldn't the counter to that be we've tried that, making everybody a homeowner, and that blew up? Like, wouldn't the counter be like almost like we have to just give people this wealth and then lock it up?
Isn't that
so
worse?
when they're old enough, they can use it.
But isn't that worse politically? Like, it's just more handouts for people that, whatever.
Well, they're all handouts.
Well, so maybe this is a good point to click on, because when you said, where does the money come from?
Mm-hmm.
I think that we've learned that we have much more capacity to spend money than we thought.
Until we don't.
So, but I guess that's like the $10 trillion question. Where is that line?
Yeah. No one knows. And I mean, a lot of it depends on the global economy. I'm a little nervous that, we kind of had that savings glut all those years where interest rates just trended down, 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 no matter how much we spent. But that was because we had a lot of foreign buyers of our debt. We don't so much anymore. Now we have the Fed buying our debt.
That's the only thing keeping the wheels on the bus, though.
But so you've seen this chart of China and their foreign purchases of our bonds, and it's going down like a lot. And it has not impacted interest rates in any way, shape, or form.
Because the Fed is buying all the debt.
Right.
What if inflation becomes an issue and they have to start selling bonds instead of buying them?
Can we have inflation without interest rates rising? Like, is that, and like you're a model person, would that break your brain?
Well, so an interest rate, a long-term interest rate is composed of, people's whatever time preference of money, like how much they want to save in the future, their expectations of future rates, and a term premium, right, which is their inflation expectations and the risk around inflation. So if inflation goes up, or people are worried inflation is going to become more risky, in theory, bond prices could go up, but those other components could go down, so it could moderate it. You never know.
And the other thing that you talk about in terms of where interest rates are is there's so many price insensitive buyers. So maybe that just breaks some of the models that we all learned about.
Like banks who are required to hold it. Yeah, I mean, effectively, this is what they call financial repression. It's like we're forcing banks to hold a lot of bonds, and then the Fed's buying a lot of bonds, and that keeps rates low.
I think you were saying, was it you? You were saying like 60% of the people involved in the Treasury market they're not traders or expressing a view on where they think rates are going. They're like pensions, and they have no choice. They have to take a certain amount of risk, and that's the only way to do it.
Yeah, I guess more in the UK where they're actually required to hold a lot of gilts.
Right.
Less so here, though. They're probably a lot of pension funds aren't de-risking as much as they used to, just because it's so expensive to do so.
Well, so you have these big pools of capital, like a pension, for example, where they hit their target already. The stock market has gone the stock market just doubled off the low. Mm-hmm. So of course they would go back to treasuries.
Yeah.
So this may be a non sequitur, but people talk about like lower rates forces people out onto the risk spectrum, which is like pretty much undeniable. But what's interesting is that the demand for fixed income is still massive. So bond ETFs added $17 billion in July, which was their 32nd month out of the last 33 with inflows. So no matter how low rates go, there is still demand for bonds.
Buying
Well,
doesn't
also,
stop.
we all do retirement, target date funds.
Right.
All these people are
They're
automatically
a
going
huge
to
player.
bonds.
There's like trillions of dollars in there.
Yeah, and it automatically puts people into bonds no matter what the prices are.
So trailing 12-month flows into fixed income, $210 billion. Mm-hmm. It's a lot of money.
Yeah.
So effectively,
so target date is like 529 plans, 401k plans, all types of insurance products. They're not like, ooh, this rate looks juicy to me. It's just automatic buying into that pool of assets regardless of the rate.
But it all makes me uncomfortable because it's all like something's like Argentinian about this, right? Like we're counting on rates staying low because of policy. Either the Fed, because even if you look at
Wait, that's provocative. Tell us why it's Argentinian.
Well,
And keep in mind, other than Sam, the rest of us in this room, John, me, Michael.
I'm literally live tweeting this right now.
We don't know anything. John's family's from Portugal. And Michael and I haven't studied this stuff, so we don't know from Argentine stuff.
It's not that bad, but roughly, like you run up a lot of debt.
Don't give me that look. You don't know shit about this, right? So Allison, tell us.
You run up a lot of debt, and then you require people to buy it, which is even with target date funds kind of the case because they're a QDIA. Like if you run a 401k and you want to have a default investment, which you're required to have, it has to have all these qualities, and target date fund fits those qualities. So it's effectively. It's policy forcing us to buy more bonds.
Okay, so
is this something that we could grow our way out of? I always hear people say grow our way out of it.
We can.
Is that
We
a thing?
did.
Yeah.
We did after World War II.
Yeah, it's possible.
We inflated the debt away. We grew out of it.
So
because GDP is
you never have to
back
pay it back. You
pre-
mean it just shrinks as a percentage of the size of the economy?
Yeah, because you as long as your growth rate has to be, you're okay as your growth rate of the economy is bigger than the interest rate.
Right.
So
I get the fears over inflation because once you have it and once you've experienced it, you never forget it. And then once you have it, it's like obviously too late at that point to really fight it. So I get why people are so paranoid, but it just seems to me like we're going to be okay.
Well, Argentina was on the hook, and they required the kindness of strangers. They needed other countries and the banks in other countries to buy their shit. We don't seem to need that. So Mike's earlier point about like China not being a big buyer of treasuries anymore, a lot of people like politically would say, "Oh, we owe China all this." They don't even want the debt anymore. They were using that for their FX
Well, they were
reserves.
also monetizing their debt. They also,
Right.
they were more dependent on foreign countries than we were, but they were also effectively requiring people to buy their own debt too.
So the Fed is monetizing the debt. Nobody seems to mind. Both parties are benefiting because they don't have to make any hard choices.
Both parties seem
They
to
just
be
say
behind
yes to everything.
Both parties seem to be behind MMT. Like, is that?
They just won't say it, or the Republicans definitely won't say it.
But that's how they're behaving.
Yeah, well, these things go on until they stop, though. That's the thing. It doesn't mean it's going to end in tears, but it's certainly a risk.
Stephanie Kelton was advising like the Biden campaign, I think.
Really?
I think maybe. I
think
might have
so.
that wrong.
No, probably.
But it's not. But it's like it's the easiest answer on earth. You never have to make any tough choices or piss anybody
But the
off.
thing is, it's like, I don't know, it's never made sense to me because like the Fed doesn't control the entire yield curve. They control the short end of the curve. There's the whole long end of the curve. And she seems to talk as if bonds are like there's just one yield curve.
Well, she would not. That theory would not have the popularity that it has now if it were being proposed 25 years ago.
But I think what I find attractive about this idea is that we could spend more than we think, but we don't just spend to spend. Like we could say if we're doing a giant infrastructure project, you go to the steel mills and whoever, whatever it is, and say, we're going to spend this amount of money. Is there capacity? Is spending this much money going to cause inflation? And I just think it's a better way to frame the argument of how much money we can actually spend versus one side saying yes and the other side saying no.
You an MMT guy?
No, but I've listened to a couple of podcasts. But yeah, that seems to be the argument, right? Like
But how do you measure that? How do you know what the capacity is? That's the thing. Like inflation and interest rates, they're market variables. Like they're unpredictable.
But at least you could talk to the producers and say, like, we want to do X. Can you accommodate that?
Yeah, but like that assumes that we do policy based on economic reasoning and not political ones.
Well, yeah, that's it.
Once we go into that world, everything's better.
Yeah. That's a mic drop, Allison. You're right.
So you don't have to believe in MMT because the people making decisions do, even if they won't call it by its name. And I don't want to say that word 5 times because it's like the Candyman, like it will appear. Like Cullen Roche will appear behind me and strangle me.
Are you seeing the Candyman? Are you going to see the Candyman?
No, I
Too
don't,
scary?
I don't like scary
But the problem
movies.
is that this is it. I don't really fully understand MMT, but from what I understand, if you do have this, so right now interest rates are low largely because the Fed is buying a lot of bonds, right? What if we have inflation and they have to stop buying a lot of bonds?
That's scary.
So MMT assumes we're just going to raise taxes in response to this high inflation environment. That's not really going to happen.
Historically, that has not been a good answer.
But
to,
what if
inflation.
interest rates are low because economies are maturing and they're low around the globe and they have been for much of the last 10 years before this?
But not before that. The economy was
before
pretty
that.
mature in the 70s.
That's what I wanted to ask you. What if it wasn't? Like what if it really wasn't? What if corporate America was dominated by companies with 5% profit margins? They were like smelting copper. Like these are the biggest companies in America. The economy now is structured very differently. It's all about intellectual property, networking effects, businesses that are born scaled effectively. Like this is a very different economy. And maybe one of the reasons why interest rates are high throughout history is a lack of trust that you're going to get your money back as a lender. And that gets eliminated by better technology. Look at all these
People are giving
fintech companies.
Microsoft money for 2%.
Yeah. So like what if we're in a situation where you can lend at a lower interest rate with more confidence because you've got better data on where you're really taking risks and who's not going to pay you back? Isn't it reasonable to think that technology is also driving a willingness on the part of creditors to lend at lower rates and therefore the natural interest rate would be lower anyway? regardless of what the Fed is doing or whatever.
That could be true, but I feel like every time we tell a story like that,
It's utopian.
Historically, then like something horrible happens.
When you read the S1, though, of these new lenders coming along, like whether they call themselves neobanks or whatever, fintech, like that is the premise of why their insurance product will be better, why their lending product will be better, because we're just smarter now. We have better technology. We know who's got a better chance of defaulting versus what we would have known 10 years ago.
Yeah, but didn't even 10 years ago we said that about the 10 years before and then the financial crisis?
Well, I hope you're wrong, because that's the premise of about $1 trillion in market cap right now.
Right, because you can never be 100% sure about anything, and that was like why VAR models and all that stuff broke down, and Nassim Taleb sold a cajillion
I
books.
don't think it's Lemonade. It's another one of these fintech insurance startups that came public. They're basically saying we're hooked into somebody's phone. We're watching them drive around. We know what the speed limit is on the streets. The phone is telling us how close they are to the speed limit via GPS. You can't tell us that we're not smarter at pricing insurance for a motorist than we would have been 10 years ago.
They don't know a Mack truck's not going to drive out into that car. I mean, that's
fine, but neither does the traditional insurance company. What they do know is who rolls through stop signs.
Mm-hmm.
They even know who's looking at their phone because they're in your phone.
They even know if you're smoking like brisket in your backyard now, right? That was one of that was another one of these S1s for one of these grill like there were these three or four grill companies that filed paperwork to go public.
Smart grills?
Yeah, smart grills.
Don't track my grill, bro.
But
I don't want a smart grill.
That's
either.
a thing now. Like some of these grills have chips in them so that they know like exactly like what kind of wood chip you're using to smoke.
And then what do they do with that? Sell you bags of that wood chip?
Maybe that's what they're doing.
They auto deliver it.
I feel like it could be partially true, but I agree with you. If we all get too confident that data is the answer to low prices, low rates forever, probably we'll end up taking more risk than we otherwise would.
Because data is always inherently from the past, used to predict the future. So it's always flawed.
I only use future data. Can we pivot to China? What do we do? What do we do with this mess? This is not going to get that. Let's start with this. The relationship between China and the Western world, purely from a capitalism perspective, it's not going to get better, right?
No, and I'm surprised anyone's surprised.
Well, the market is not panicking about this. The stock market is not panicked about what seems to be a new iron curtain coming down, almost mutually agreed upon, where we don't want their companies listed here anymore, and they don't want their companies listing here anymore or complying with our listing. And now pretty much every deal is canceled. You're not going to see any new ones. But there's what was the market cap amount in Chinese stocks? Did we get that information?
Carry on. I'll get it for you in a sec.
Okay. So let me just read you this from I guess this is Wall Street Journal. Some market participants believe China is trying to direct capital and human resources away from internet companies into sectors that will help the country become more self-reliant. They are trying to reach a new equilibrium because it seems capital flows were not in line with long-term top-down priorities. So basically that's Beijing telling the stock market, I guess, don't invest in these companies anymore. We don't view them as being helpful to society. Invest in these companies. Is that unprecedented, or do we see that around the world and we do it here too?
Not to the same extent. I mean, East Asian countries have always, engaged in a lot more industrial policy than we have.
Right.
But in some ways, I feel like this is, I don't think there's going to be a new Cold War. We're still going to trade with China. We have too much, our economies are way too integrated to just completely decouple. On the other hand, this actually, I think, is just bad for Chinese innovation. Innovation doesn't happen where you expect it does. Like there could be some video game technology that someone creates in China that ends up having this profound impact on all our lives.
But they don't want it. Like Ant is an offshoot of the online marketplaces business. They needed a way to pay for goods that was seamless. And then you end up with the biggest fintech company in the world. And Beijing basically says, no IPO. We don't want foreign money invested in this thing. We don't want the data being shared, whatever. They don't seem to want innovation. They seem to want to grasp back.
So they're never going to be like a serious economic leader.
Okay.
If you're not innovating, you're not a major you can grow based on the size of your population and how much capital you throw at people, but you're never coming up with that intangible capital that
this
really
is worse
makes
for them than for us.
Yeah, I think this for me really, not that this was keeping me up nights because it doesn't really bother me if that were true either way, but like in terms of worrying that China was going to overtake us, at least in terms of per capita terms, I think we can worry a lot less about that.
All right, here we go. Check this out. So this chart is showing the green line is the MSCI China Index. Obviously, you know it's getting the shit kicked out of it. The pink line are U.S. domiciled China-specific ETPs year to date. These are the flows.
ETPs are exchange traded funds.
Right. So people are investors are going nuts. They're not relenting.
They're buying.
They're buying. John, we have a few other charts here.
That's cumulative flows to China?
Yep.
Okay.
China-specific. So this next one, this is as of the end of July. And these things were crashing then. So look at KWeb. The flows into this, Chinese technology stocks are going gangbusters.
This is as prices are crashing. What if this is just automated rebalancing trades?
That's not on. Look at that, dude. That's
all
vertical.
right, the purple line is KWeb.
That's vertical.
That's our friend Brendan's China Internet ETF. Let's put that one aside.
But look at FXI too. That's nothing.
That could be rebalancing. That's Chinese companies trading on the London exchange, like Chinese blue chips, Hong Kong.
These are foreign investors?
This is US.
These are US products that US dollars are going into.
And we've got one more cool chart. This is all from iShares, by the way. I'll throw this up on the blog. All right. So what you're showing here is, let's look at the left-hand side. So emerging market mutual funds are $800 billion. The China-specific ones are tiny, which is super interesting because China is like a third. So I guess people are getting all their exposure to China through the indexes, and they're not allocating specifically to China in a big way.
People are US investors are buying the asset class, emerging markets. They're not bulled up specifically on China to begin with.
Right.
Okay. So they're getting a lot of what? South Korea? Like what are they getting in these products if it's not China specific?
No. What China specific is, you see the red and yellow on the bottom?
Yeah.
That's people that are allocating specifically to Chinese ETFs. So KWeb is in that column. Okay. So the purple line shows overall, it's 4% of AUM of emerging market assets. 4% is in China specifically.
Here's a problem if you're a US investor then. You have this diversified portfolio, you own ETFs, you have foreign stock exposure. A lot of it is China. China's 10% of the all country world index, ex-US, right?
Yep.
It's like a lot. It's big. Is it bigger than every country in Europe individually?
Oh yeah. The only one that's bigger is Japan.
Maybe I should be rebalancing.
Yeah, maybe rebalance. So then the question
I
is
have a lot of emerging markets.
Well,
yeah.
I mean, I mean, we're all speaking here like this is over.
I think it's just starting. I mean,
I'm
not Ian
over in
Bremmer.
that, in that, like it's time to get out of China. Like
Well,
it's not like some kind of feint where
This could be a great buying opportunity.
It's risky.
Like, could it
I
be?
think it's super risky. Like it doesn't mean it's going to go badly, but like there's more risk around it.
there's like $1 trillion in US, not just individual investors, but like every major asset management firm has money in China. And they're like saying publicly they don't like the structure of these things going public as shell companies in the Caymans and then listing a ticker and saying it's representative of Alibaba or all the other, there's 50 other.
So Tencent went from 100 to 55. Baidu went from, let's see, 355 to 160.
Yeah.
So these things are all cut in half and worse, or a lot of them.
So how is this like? I'm trying to understand like what the difference is between this versus what they teach you in emerging markets investing 101. Like the first chapter of it.
Geopolitics.
Yeah,
Biggest risk.
geopolitics and regulatory risk.
Yeah.
So
here it is.
Well, so if we believe that risk and reward are tied, like this is what it is to invest in emerging markets. This is part of it.
The problem is though, you've had no reward.
That's true.
In the last 15 years, emerging markets have sucked.
It's been a minute.
As an asset class. So it looks like if you're just looking at trailing performance, you're taking all the risk with no premium return for it.
Tough.
Like, why would you, so maybe that's the opportunity and maybe that's why all that money is flooding into the products.
So
I don't know.
But I think also China, in terms of geopolitical risk, is larger because like if you're a smaller country, there's only so many crazy things you can do.
And there's not enough stocks for people to buy a lot of.
Yeah.
So this is different.
Yeah, because it's the sheer size of it.
This is massive. So I'm surprised that it hasn't been like a shock systemically to just investors generally who are watching this go on and they don't know what's going to come next.
It's especially the way people have been talking about China over the last 10 years. Like, remember when people used to always say their currency could become the global reserve currency? I was just like,
This sets that back, right?
I don't know why anyone ever believed it to begin with. It's always going to be manipulated. You can't have a global currency. I mean, I guess you could.
Not like what we do here, though.
No, because it's a pure price. It's a pure market price.
It's all manipulated. It's how out loud are you manipulating, right?
Yeah, we're a little bit less obvious.
All right, let's pivot. Let's get into this social aspect of physically going to work. Sam, this is you?
Yeah, I tossed that in kind of last minute. I mean, it seems...
I agree with it.
Yeah, I mean, so this is a new survey from ADP came out, and, it basically reveals a lot of, I think what people have already suspected, that there are certain components of being in an office that people find advantageous, like whether it's, talking to the boss or, those sort of, random moments where you're brainstorming with someone and someone comes up with a great idea. But I think something that, isn't getting talked about enough is actually just that social component of like, maybe we're not talking about work, but we're going to talk about movies. And it turns out that we like the same movies. We're going to go see a movie.
It's team building.
Yeah.
You like the people that you work with.
Right. And like,
On the plus side, sexual harassment way down.
Yeah, I mean,
it's hard. It's really hard to do that on Slack. It turns out.
Right. Yeah. I mean, and just to sort of spin that a little bit too. But like, think about how many people like met their spouses through work or
My parents. I shouldn't even be alive. My parents met in the 1970s at Burlington. Not the Coat Factory, but it was like a garment center company. Like they made fabric. It was very high tech. So like, my mom was my dad's secretary. My parents would be arrested now, right? if they like tried to get married that way. So I don't know where I'm going with that. It's very dark.
I think the message is.
You feel me on that though?
Yeah, not everyone is sexually harassing each other. Like some people are.
Just most people.
Yeah,
I'm on Twitter, so most people.
Not to sort of downplay that, but I'm trying to play up like these actual normal relationships that people form.
Right.
In work. And,
for people under 30, I think it's very difficult to climb the ladder without being in the office. I don't even know how you accomplish that.
Yeah, because you need some senior person to really invest in you.
Right. Yes. Recognize like your work.
And like, I know I got ahead various points in my career where some senior person like took a bet on me that I didn't deserve.
Right.
And that person is Gene Fama. Nobel laureate, right? Am I lying?
No, it was more Merton, but
Merton?
Yeah.
Okay. Did he win a Nobel?
Yeah.
Okay, so good enough.
Mm-hmm.
Right.
Good enough. But yeah, I mean, how are you going to get that senior person to invest in you if they've never met you?
Right, because that all involves trust too, right?
And beers.
And beers.
That's the only way that you build that trust.
Right, exactly. Like, that's, this is what you get when you interview people for jobs, right? It's like someone could be amazing on paper and have a 4.0 and like, understands everything about your subject area.
And then you meet them, they're a close talker.
Right, and they become a close target, in which case, working from home is actually a great situation.
You know why this is so true? Every business book you read about like CEOs who built great companies, like their superhero origin story is always the fucking mailroom. Yep. And they were sweeping up late one night and somebody said, hey, come have a drink with me. Or they were bringing somebody coffee. Like that's everybody's story of how they gained the first rung of the ladder. Yep. How does that take place if 75% of office workers are not showing up for prolonged periods of time? Think about how many missed opportunities for careers that we're not even thinking about the impact of that.
But so what if it's not one extreme versus the other? Like I'm in 1 day a week. And I'm sure there's going to be a lot of companies that are in 3 days a week. Like I don't think it's going to be necessarily all or nothing because you need that face-to-face activity. Yeah,
but so refute that a little bit. Like I come in the same day as you. Alex is here, Cameron's here, Dylan's here. I'm like, high five from across the room. We're not like really working together.
Right.
And it kind of sucks.
Yeah.
I wish it were otherwise, but
I mean, it's definitely sort of, on a scale. It's on a spectrum, right? Because there's people who, aren't going to go back to the office for months because they can work from home. I mean, that's very different from going in.
Google's employees agreed to a pay cut if they could stay home.
Oh my God, yeah.
Would other companies offer that choice, and what would the results be? Probably the same, which is maybe not great. Maybe I don't know.
It's too hard to have a good culture.
I mean, Google's culture is.
I don't know what my employees would say, but most of them are remote anyway, so it's a little bit different.
Are they still going to give you such good food and games if everyone's working from home?
That's a good question.
I mean, what's Bloomberg's snack cabinet like these days?
That's hilarious, right? It's like not only are they paying their employees less, but now they don't have to pay for that commercial office space. They don't have to pay for food.
And that's where productivity comes from.
There you go. And then net profit margins explode.